Hi there. If your business is VAT registered in the UK, MTD is already mandatory. In this video, we explain how to integrate MTD systems smoothly.
Mastering your current digital VAT workflow will not protect you from the next phase of compliance. VAT stands for Value Added Tax, a consumption tax assessed on business sales. While that system is already active, April 2026 brings the rollout of Making Tax Digital for Income Tax, or ITITSA. ITITSA stands for Income Tax Self-Assessment, the system used to report personal and business income. Under these new rules, previously separate revenue streams, like freelance invoices, online e-commerce sales, and property rental income, will be pulled together into a single, mandatory quarterly digital reporting system overseen by HM Revenue and Customs. Failing to integrate these separate systems before the deadline guarantees administrative gridlock. It also exposes you to a new, aggressive system of penalty points for every missed or improperly formatted submission. This video provides a concrete 4-step roadmap for integrating your VAT and income tax reporting into a single, automated framework. The 2026 rollout forces taxpayers to abandon the chaotic year-end scramble. Instead, tax compliance must become an automated, invisible background process that runs continuously throughout the year. Currently, mandatory digital VAT reporting applies to businesses that cross the established £90,000 rolling turnover threshold. This side-by-side comparison chart shows exactly how the thresholds differ. On the left, we have the familiar £90,000 VAT marker. On the right is the new ITSA mandate, which activates on April 6, 2026 for incomes over £50,000, before dropping to £30,000 in 2027. Notice how the ITSA column fills up. HM Revenue and Customs determines your eligibility by looking at your combined gross income from the 2024 to 2025 tax year. If you earned £40,000 from freelance work and a £15,000 side hustle, your combined total breaches the threshold. This creates an unexpected trap for full-time workers. If you are a PAY employee, meaning your employer deducts tax from your paycheck automatically using the pay-as-you-earn system, but you also generate £55,000 in gross property rent, that rental income alone pulls you directly into the ITSA net. Looking at income streams in isolation is no longer legally safe. HMRC now views your total economic footprint, demanding a unified tracking approach for every pound you earn. To comply, you must use functional compatible software. This means your digital record-keeping tools must connect directly to HMRC systems using an API. An API, or Application Programming Interface, is a digital bridge that allows two different software programs to securely share data without human intervention. This flow diagram illustrates the legally required digital link. You can see raw data entering a cloud ledger, moving through bridging software, and finally submitting to HMRC along continuous, unbroken electronic lines. Watch what happens if you try to manually copy and paste data between your spreadsheets. Doing this explicitly breaks the digital link and violates Making Tax Digital law. For e-commerce sellers, there is a specific danger in how revenue is recorded. If you enter your net bank deposits without separating out your gross sales and the platform fees, your records will distort both your VAT calculations and your ITSA reporting. Integration middleware, like A2X or Link My Books, solves this distortion. These programs automatically split your gross sales and platform fees before the data ever reaches your main accounting software. The simplest technical solution for establishing your initial digital links is to open dedicated business bank accounts and activate automatic open banking feeds, routing your transactions directly into your ledger. The digital link requirement alters the nature of audits. HMRC is now legally evaluating the unbroken integrity of the data's journey through your systems, not just verifying the final submitted numbers. The new mandate replaces the single annual tax return with a continuous reporting cycle. You will now submit 4 mandatory quarterly updates throughout the year, followed by one final year-end declaration. To enforce this rhythm, HMRC is deploying a points-based late submission penalty system. This replaces the old automatic flat fines with a cumulative tracking model. This tiered tracker graphic shows the exact penalty progression. For every missed quarterly deadline, you accumulate a point. Hitting 4 points triggers an immediate £200 financial penalty. The graphic now expands to show late payment penalties. If your tax remains unpaid past the 30-day mark, the penalty escalates severely, jumping to an annualized 10% interest rate. There is a brief reprieve for the 2026 to 2027 tax year. HMRC is providing a soft landing. While late payment interest will still apply, they will temporarily pause the late submission points for your first 4 quarterly updates. The new penalty regime is designed to reward consistent, automated reporting rhythms, while heavily penalizing manual disorganization and procrastination. The roadmap for 2026 readiness requires 4 precise steps: audit your 2024 to 2025 qualifying income, upgrade to API-compatible accounting software, enforce unbreakable digital links across your platforms, and transition your internal workflows to a quarterly reporting schedule. Tax regulations are highly complex and frequently updated. This guide provides a strategic overview, but does not replace formal financial or legal advice tailored to your specific situation. To execute this transition safely, My Tax Accountant, or MTA, operates as your implementation partner. They evaluate software options, architect the required digital links, and manage your quarterly filings. You can reach MTA by phone or email to schedule a complimentary compliance consultation. Subscribe to this channel to receive ongoing updates as HM Revenue and Customs releases further technical guidance. Preparing for the 2026 integration builds a resilient, automated financial infrastructure. Once your compliance runs securely in the background, you reclaim the time needed to focus entirely on growing your business.